the stock market goes up. 70% of all trading days in history, up. Over the last 100 years, the S&P 500 has returned an average of 10% per year. 10%. Every year. On average. That's not a secret. That's public knowledge. So here's the question nobody asks. If the market goes up 70% of the time, why does the average retail investor earn less than 4% a year? Same market. Same stocks. Less than half the return. That gap is not bad luck. That gap is not a coincidence. That gap is a mechanism. And today we're going to break it down. Volatility is not a bug in the stock market. It is the feature that transfers wealth from people who sell with fear to people who buy with patience. Let's start with a study most people have never heard of. Every year, a research firm called DALBAR tracks investor behavior. They compare what the market actually returns versus what the average investor actually gets. Over 20 years, the S&P 500 returned 10.65% per year. The average retail investor, 4.08%. Same market, a 6-point gap, every single year. The reason is one word: behavior. Specifically, selling when it feels like the world is ending. Now let's look at what a crash actually looks like from the inside. 2008. The market drops 57%. Headlines say the system is collapsing. Retail investors, people like you and me, sell. Institutional investors, hedge funds, pension funds, the big money, buy. By 2013, the market had fully recovered. The people who sold in 2008 locked in a permanent loss. The people who held or bought captured the entire recovery. Here's what nobody in financial media will tell you. Institutional investors need retail investors to panic. That's how they accumulate positions cheaply. When you sell your shares in a crash, someone is buying them. That someone is not another scared retail investor. That someone has billions of dollars, infinite patience, and no mortgage payment due next Friday. Financial media profits from your anxiety. More fear equals more clicks. More clicks equals more ad revenue. Volatility is not random noise. It is the price of admission for long-term returns. The market does not reward people who pick the right stocks. It rewards people who can sit still while everyone else panics. So here is the mechanic that changes everything. Time in market always beats timing the market. Always. An investor who put $10,000 into the S&P 500 in October 2008, right at the peak of the crash, worst possible timing, still made over 250% by 2024. The investor who sold at the bottom locked in negative 57%. Forever. 3 mechanics to remember from today. 1. Automate your investments. Remove the emotion entirely. 2. Never check your portfolio during a crash. Watching guarantees you'll feel the urge to act. 3. Volatility is not risk. It is opportunity, for anyone with time on their side. The market is not designed to make you rich quickly. It is designed to transfer wealth slowly, from the impatient to the patient. That is the financial mechanic most people learn too late. If this changed how you see the market, subscribe. We cover 1 mechanic per video. That's the only format we run here.